Welcome to Your Inbox Last Night, where we break down the fintech chaos so you don't have to. I'm Michelle Tivy. Today is February 20, 2025, and we've got a packed episode. Think AI risks in banking, a $35 billion merger that creates a banking behemoth, and Doge's mysterious $50 billion savings. Buckle up. First up, let's talk about the regulators who are once again feeling uneasy about the future. Banking Dive reports that Michael Barr, the Fed's vice chair for supervision, is sounding the alarm on AI in banking. He's concerned that artificial intelligence could introduce bias into financial decision making and create cybersecurity vulnerabilities. Regulators are now considering tighter oversight, and if this takes off, fintechs and banks might be looking at major compliance headaches. According to Banking Dive, President Trump is flexing executive power with a new order requiring independent agencies like the Fed, SEC, and CFTC to submit major regulatory moves for White House review. Some see this as an accountability boost, while others worry it's a political overreach. Either way, expect tensions between regulators and the administration over who really controls financial policy. American Banker reports that the Federal Reserve has quietly removed a long-standing policy hurdle that previously blocked crypto banks from accessing central banking services. This opens the door for fintechs and digital asset firms to compete with traditional banks. While the move is being celebrated in the crypto world, critics warn that without proper oversight, this could create more financial risks down the road. Now let's shift to the big money moves shaking up the industry. In Banking Dive last night, shareholders at Capital One and Discover voted to approve a $35 billion merger. If regulators sign off, this deal would create the second largest credit card issuer in the U.S., right behind Chase. But antitrust concerns are looming, and regulators are expected to scrutinize whether this merger is a win for consumers. But, well, let's see. Most of the federal workforce has got pink slips. The CFPB was locked up and shaken out. Oh, and don't get me started about not getting the 200 new bank regulators the FDIC hired. What I'm saying is, they already pushed this closing back once, and raise your hand if you see this transaction hitting the desk of a regulator in the next 48 months. Yeah, I didn't think so. American Banker reports that JP Morgan Chase is tightening Zelle limits after fraud cases surged. Customers will now face lower transfer caps and additional security measures. The big question, will this crackdown actually deter scammers or just make it more frustrating for legitimate users? Digital Transactions says MasterCard is rolling out One Credential, a new product aimed at Gen Z that consolidates multiple payment methods into a single card. At checkout, users can switch between credit, debit, and BNPL, making payments more flexible. If adoption takes off, this could fundamentally change how younger consumers manage their money. And now, the latest drama in the world of digital assets? The New York Times reports that a Kansas-based cryptocurrency scam defrauded investors of millions, luring victims with fake investment platforms and exaggerated return promises. Regulators are investigating, but as always, the question remains, will victims ever see their money again? As someone who has been rugged more than once, let me be the first to say, not bloody likely. According to Mondoc, Nigeria has filed an $81 billion lawsuit against Binance, accusing the exchange of economic instability and tax evasion. Binance is fighting back, but this could set a dangerous precedent for crypto platforms operating in emerging markets. If Nigeria wins, could other countries follow suit? Now let's turn to some of the sharpest minds in fintech, our favorite Substacks. Fintech Takes reports that embedded lending is transforming small business financing, allowing companies to access credit directly within their existing platforms. AI-driven underwriting is speeding up approvals, but concerns about algorithmic bias persist. Could this be the future of small business lending, or just a new source of risk? And finally, a few stories they don't want you to hear. It's time for Mr. X.
Well, ain't it the truth, Miss Michelle? Ain't it the truth? According to the global treasurer, Dogecoin is claiming to have saved $50 billion through cost-cutting measures, but analysts aren't convinced. Some insiders are whispering that this might not be a strategic play. It could be the setup for a massive liquidity event. Is a major Doge sell-off on the horizon? Meanwhile, lots of folks are nervous about this burn it all down. Aggressive financial deregulation is picking up speed, but opinions are split. Some say this will fuel economic growth, while others warn it's setting up the next financial crisis. Mr. X says to watch the banks. They know what's coming before the rest of us do. And here's a Mr. X special report. Pull up a stool and sit a bit. My dears, gather round. There's something rotten in the state of Solana, and it smells an awful lot like an FTX-style implosion waiting to happen. You may have caught whispers of a mysterious $200 M insider transaction orchestrated by our favorite shadowy figures at Kelsier Ventures. But what if I told you this wasn't just a typical rug pull? Nope, this one has presidential fingerprints all over it. Picture this. Argentina's Javier Milei, the free market libertarian firebrand, and Melania Trump, the ever enigmatic first lady, both linked to meme coins because of course they are. Libra was President Milei's flirtation with crypto, and Melania, well, you know who that is. Both of those were allegedly funneled through Kelsier's hands. What's the scam? Let's just say pumping a coin and then pretending you've never heard of it is a time-honored tradition. Milei backed away when things got too hot. And Melania, well, she's never been one for answering questions. Kelsier isn't run by your average Ivy League finance bros. Nope, it's a family business led by Hayden Mark Davis, his father Tom Davis, and wildcard Gideon Davis. Hayden is one of those self-proclaimed serial entrepreneurs with a LinkedIn that looks like a thrift store clearance rack. Time, let's just say he's got a colorful past featuring identity fraud and enough personal scandals to fill a reality show. Gideon was behind Unlock and Neo Nexus, two DeFi projects that, what's the phrase? Crash and burn spectacularly. Is this FTX too? We all remember FTX, Sam Bankman-Fried's digital Ponzi palace that detonated $8 billion in customer funds overnight. While Kelsier isn't running an exchange, their game smells just as foul. Market manipulation, meme coin pumps, insider dumps. But this time, it's all happening in Solana's ecosystem. And if Solana suddenly finds itself at the center of yet another catastrophic failure, well, expect some familiar fallout. Just when you think it couldn't get messier, word on the street is that Kelsier was shopping this same scam in Nigeria, cozying up to government officials to launch another political meme coin grift because why stop at one continent when you can grift globally? If you want to know how bad this is, even DeFi Tuna, a DeFi influencer with a sketchy past himself, publicly cut ties with Kelsier and returned their $30,000 investment in protest. When your fellow schemers don't want your money, you know the jig is up. So what's the verdict? A Solana implosion? Another crypto black swan? Or just business as usual in the wild west of Web3? Keep your eyes peeled, kittens. Mr. X is watching.
Thanks for joining us again for today's episode of Your Inbox Last Night. I'm happy to say the response to this new effort has been overwhelmingly positive. Thanks for telling your friends to subscribe. If found this newsletter podcast useful, hit subscribe, share with a friend, and stay ahead of the fintech curve. I'm Michelle Tivy. See you tomorrow.